Markets are often described as systems of numbers, charts, and policies, but that description misses the most important ingredient. Markets are not held together by money. They are held together by belief. Belief that rules are enforced, belief that institutions function, belief that power is constrained by consequence. History shows that when belief weakens, markets do not collapse immediately. They hesitate. They slow. They begin to behave differently. In this video, we are not discussing individuals. We are not examining scandal. We are examining something far more important. We are examining how unresolved institutional failures quietly damage confidence, and why that damage eventually shows up in markets, currencies, and capital flows. The Epstein Files are not important because of what they allege. They are important because of what they reveal about how systems respond when accountability becomes inconvenient. And once confidence breaks, markets always follow. Markets are often explained through numbers, interest rates, earnings, debt ratios, inflation curves. But history shows that numbers alone do not sustain markets. What sustains markets is confidence, a shared, often unspoken belief that the system itself is functioning as intended. This belief is not emotional optimism. It is structural trust. Participants must believe that contracts will be honored, that disputes will be resolved, and that rules will be enforced consistently enough to make long-term decisions possible. Markets can survive bad policy. They can survive poor leadership. They can even survive recession. What they cannot survive for long is the perception that the system is no longer coherent. Because markets are not moral systems. They are coordination systems. They exist to allow millions of people, most of whom do not know one another, to act as if the future is navigable. That coordination depends on a single assumption, that the framework holding everything together will not suddenly change without consequence. This is why markets respond so aggressively to uncertainty. Bad news can be measured, losses can be priced, even collapse can be modeled. But uncertainty, especially institutional uncertainty, cannot. When confidence is intact, investors tolerate volatility. They accept risk because they believe outcomes will follow rules. When confidence weakens, behavior changes before prices do. Capital becomes cautious. Time horizons shorten. Liquidity quietly retreats. This shift is rarely dramatic at first. It is subtle. Markets still function. Trades still clear. Headlines still report stability. But underneath, the system begins to rely more heavily on momentum than conviction. History shows this pattern repeatedly. Late-stage Roman markets, pre-collapse financial systems in interwar Europe, modern economies before currency crises. In every case, the visible damage came last. The invisible damage came first. Confidence erodes not when systems fail completely, but when they behave inconsistently, when enforcement appears selective, when accountability slows, when consequences no longer align with expectations. Markets watch these signals carefully, not because they are political, but because they are predictive. If rules apply unevenly, then risk cannot be properly assessed. If enforcement depends on status, then contracts lose meaning. If accountability becomes negotiable, then stability becomes temporary. At that point, markets do not collapse. They adapt. And adaptation is the beginning of withdrawal. This is why confidence is the true foundation of markets. Not optimism, not growth, not even trust in leadership. Confidence in the system's ability to correct itself. Once that belief weakens, every other metric becomes less reliable. And history shows that when confidence finally breaks, markets do not fall because of one event. They fall because belief had already left. Markets do not observe morality. They observe process. They do not react to outrage. They react to behavior. When an institution is tested, Legally, ethically, or structurally, markets are not asking whether the outcome feels just. They are asking something far more practical. Does the system still enforce its own boundaries? This is where institutional failure becomes a market signal. The Epstein Files represent a situation where pressure was applied to multiple layers of authority at once: legal, political, financial, and social. What matters for markets is not the narrative surrounding the case, but the sequence of institutional responses that followed: delays, jurisdictional fragmentation, procedural ambiguity, inconsistent outcomes. Each of these elements communicates information to markets. Not explicitly, but unmistakably, markets understand that no system is perfect. They tolerate flaws. They price inefficiency. What they cannot tolerate indefinitely is patterned inconsistency. When institutions behave predictably under pressure, confidence is reinforced, even if the outcome is unpopular. When they behave inconsistently, confidence weakens, even if the outcome appears stable. This distinction is critical because markets are forward-looking systems. They are always asking, what happens next time? When accountability appears delayed or diluted, markets begin to revise their expectations, not about justice, but about risk distribution. If enforcement can be deferred, then exposure increases. If responsibility can be dispersed, then guarantees weaken. If consequences can be negotiated, then stability becomes conditional. This is how institutional failure quietly migrates into economic behavior, not through panic, through recalibration. Capital does not flee immediately. It hedges. Long-term commitments shorten. Investment horizons compress. Liquidity becomes selective. These shifts are invisible to the public but obvious to participants. History shows that once markets begin adjusting for institutional unreliability, the system enters a fragile state, one where stability depends increasingly on confidence rather than structure. This is dangerous territory, because confidence is not renewable on command. Institutions often assume that silence preserves stability. In reality, silence transfers uncertainty to the future, and uncertainty compounds. Every unresolved failure becomes precedent. Every precedent weakens deterrence. Every weakened deterrent alters behavior. This is not theory. It is historical record. From late imperial administrations to modern financial systems, collapse rarely begins with a single scandal. It begins when systems demonstrate that self-preservation overrides correction. Markets are exceptionally sensitive to this shift, because once a system prioritizes protecting itself over enforcing its rules, it ceases to be predictable, and unpredictability is the enemy of capital. At that point, markets no longer assume that outcomes will follow procedure. They assume outcomes will follow power. That assumption changes everything. Risk becomes political. Pricing becomes speculative. Stability becomes performative. The Epstein Files matter here, not because of what they accuse, but because of what they reveal about institutional behavior under strain. They show how systems respond when accountability threatens legitimacy. They show how complexity is used to absorb pressure. They show how resolution can be postponed without appearing to fail. But history is clear on this point. Systems that delay correction do not avoid collapse. They postpone it. And when correction is delayed long enough, markets stop waiting. They begin preparing for failure instead. That preparation does not announce itself. It does not make headlines. It does not look like crisis. It looks like caution. And caution, sustained long enough, becomes withdrawal. Economic systems do not collapse when they run out of money. They collapse when they run out of legitimacy. Legitimacy is the invisible agreement between institutions and participants that rules matter, boundaries exist, and authority is exercised within limits. It is not the same as popularity. It is not the same as approval. A system can be deeply unpopular and still legitimate. But once legitimacy erodes, stability becomes performative. Markets are especially sensitive to this distinction. They do not require fairness. They require credibility. Credibility means that outcomes follow processes, not status. That enforcement is predictable enough to model. That power is constrained enough to be priced. When legitimacy exists, markets tolerate inequality, inefficiency, and even corruption. History proves this repeatedly. What markets cannot tolerate is uncertainty about whether the system still believes in its own rules. This is where legitimacy becomes an economic variable. The moment participants suspect that enforcement is selective rather than structural, risk assessment changes. Not dramatically, quietly. Capital does not leave all at once. It repositions. Long-term investment becomes conditional. Productive risk gives way to defensive allocation. Liquidity favors proximity over opportunity. This is not ideology. It is survival logic. In every historical collapse, there is a moment when belief in correction disappears. Not belief in growth. Not belief in leadership. Belief that the system will self-correct when boundaries are crossed. Once that belief is lost, markets stop assuming continuity. They begin assuming contingency. This is the point where empires still look strong, currencies still trade, and institutions still issue statements, but the foundation has already cracked. The Epstein Files are relevant here not as a scandal, but as a signal. They demonstrate what happens when legitimacy is tested at the highest levels and resolution becomes structurally difficult. Markets observe this carefully. They ask, if correction stalls here, where else does it stall? If enforcement weakens here, where else is it negotiable? If accountability dissolves under pressure, what does that imply about future crises? These questions do not produce immediate panic. They produce conditional trust, and conditional trust is unstable. Once legitimacy weakens, every additional stress multiplies the damage. Debt becomes harder to sustain. Intervention becomes less effective. Policy loses credibility faster. This is why late-stage systems rely increasingly on signaling rather than substance. Words replace enforcement. Announcements replace outcomes. Narratives replace resolution. Markets recognize this shift instantly. Because markets do not trade stories, they trade probability. And when legitimacy declines, probability widens. Outcomes become harder to predict. Risk premiums rise. Volatility increases without obvious cause. Observers often misinterpret this phase. They search for a trigger. They blame sentiment. They look for bad actors. But the cause is structural. Legitimacy has thinned. The system still functions, but it no longer commands belief. And belief, once lost, is not restored by reassurance. It is restored only by consequence. History is unforgiving on this point. Systems that fail to restore legitimacy do not gradually recover. They persist until stress exposes what confidence had already withdrawn from. And when that happens, collapse appears sudden, but it never is. It is simply the moment when markets stop pretending. Silence is often mistaken for restraint. In institutional systems, it is frequently interpreted as stability. History shows this is a dangerous misunderstanding. Silence is not the absence of action. It is a choice that carries consequences. When institutions face credibility challenges and choose delay, deflection, or procedural quiet, they are not preserving order. They are reallocating risk. And markets are exceptionally sensitive to that reallocation. Economic systems rely on visible correction mechanisms, not perfect ones, visible ones. Correction signals that boundaries still exist, that errors are absorbed and resolved, that the system is capable of disciplining itself. When those signals disappear, markets do not assume calm. They assume unresolved strain. This is why silence is never neutral in economic history. It creates an information vacuum, and in markets vacuums are filled with assumptions, rarely optimistic ones. When institutions remain silent during moments of accountability stress, they unintentionally communicate several things at once. That resolution is difficult. That enforcement may be negotiable. That consequences may be uneven. That precedent is being quietly established. Markets translate these signals into probability. They do not ask why silence exists. They ask what it implies. Silence implies that correction carries a cost. The system is unwilling to pay. That insight alone is enough to alter behavior. Because if correction is optional, then rules are conditional. And if rules are conditional, then risk cannot be reliably priced. This is where silence becomes a market variable. Capital responds by becoming cautious, not reactive. It begins to favor liquidity over commitment, mobility over productivity, optionality over growth. These shifts do not generate headlines. They do not appear as collapse. They appear as subtle inefficiency. Investment slows. Projects shorten. Confidence becomes fragmented. Observers often misread this phase as resilience. Markets still operate. Indices still move. Institutions still speak, just not about the issue that matters. But history shows that this is the most fragile phase of all, because stability during silence is borrowed time. Silence does not remove pressure. It stores it. The Epstein Files are instructive here, not because of their content, but because of the prolonged quiet surrounding resolution. That quiet created ambiguity. And ambiguity, sustained long enough, changes how systems are perceived. Markets begin to treat institutions not as enforcers, but as negotiators. Not as arbiters, but as participants. This perception shift is critical. Once institutions are seen as actors with interests rather than referees with authority, the system loses neutrality. And neutrality is the backbone of legitimacy. Without it, markets begin to assume that outcomes depend on leverage rather than law. At that point, capital no longer competes on productivity alone. It competes on access, insulation, and escape routes. This is how silence alters economic structure without altering appearance. It rewards proximity over merit. It favors insiders over entrants. It discourages long-term planning. The system still exists, but it becomes inward-facing. History is clear on what follows. Systems that rely on silence to manage credibility challenges become brittle. They appear calm right up until stress exceeds tolerance. And when stress finally forces resolution, the outcome is rarely controlled. Because the system no longer commands belief, it merely demands compliance. Markets do not operate on compliance. They operate on confidence. Once silence replaces correction, confidence erodes, even if prices do not. This is why the most dangerous phase of economic decline is not collapse. It is quiet. Quiet is when assumptions change. Quiet is when capital prepares. Quiet is when belief leaves before anyone admits it has gone. And when belief finally surfaces as absence, the reaction feels sudden. But it is not. It is simply the delayed cost of silence being paid all at once. Markets are often described as forward-looking. In theory, they price the future. In practice, markets are confirmation-driven systems. They do not move when risk appears. They move when risk becomes undeniable. This distinction explains nearly every historical collapse. If markets truly reacted at the first sign of danger, stability would be impossible. Every system would constantly reset. Capital would never commit. Long-term planning would cease. Delay is not a flaw. Delay is what allows markets to function at all. But that same delay becomes dangerous when the nature of risk changes. Markets are designed to absorb quantifiable risk. Interest rates, default probabilities, Earnings volatility, currency fluctuations, they are not designed to process structural credibility failure. Structural failure does not announce itself in numbers. It reveals itself in behavior. This is why markets appear calm long after foundations have weakened. Participants continue to operate under inherited assumptions that institutions will intervene, that enforcement will reassert itself, that correction will eventually occur. These assumptions are not irrational. They are historically reinforced. For decades, systems have absorbed shocks through intervention, liquidity, and delay. Markets have learned that patience is rewarded. So when early warning signals appear, legitimacy erosion, enforcement inconsistency, unresolved institutional failure, markets treat them as temporary anomalies, not structural shifts. This is the first reason markets react late. They assume continuity. The second reason is incentive alignment. Most market participants are not rewarded for being early. They are punished for being wrong. Exiting too soon carries immediate cost. Opportunity loss, underperformance, reputational damage. Remaining invested carries delayed risk. In environments where confidence has not yet collapsed, staying exposed often appears rational, even prudent. This creates a collective hesitation. Everyone sees the stress. No one wants to move first. This is not denial. It is coordination friction. Markets are coordination machines. They require shared belief to move decisively. As long as belief persists, even weakly, action is postponed. This produces the illusion of resilience. Prices hold. Liquidity flows. Institutions issue assurances. Observers mistake this for strength. In reality, it is inertia. The third reason markets react late is that modern systems are buffered. Debt, intervention tools, monetary policy and regulatory frameworks are designed to smooth volatility. They work until they don't stet. These buffers delay visible consequences, allowing structural damage to accumulate unseen. By the time price signals appear, the damage is already mature. This is why collapses feel sudden. They are not sudden. They are released. The Epstein Files matter here, not because they introduce shock, but because they illustrate how modern systems manage discomfort, delay, complexity, process without resolution. Markets interpret this pattern not as stability, but as deferred reckoning. Yet they do not respond immediately because the system still functions. Contracts still clear. Banks still operate. Currencies still trade. As long as surface functionality remains, markets tolerate internal decay. History shows this clearly. Late-stage empires did not collapse during scandal. They collapsed during stress, applied to already weakened legitimacy. The stress can be external, war, supply shock, demographic pressure, or internal, debt saturation, monetary exhaustion, political fragmentation. What matters is timing. Markets react late because they wait for stress to confirm fragility. Until then, belief persists. Another reason markets react late is narrative substitution. When institutions fail to resolve credibility challenges, they often replace action with explanation, statements, reassurances, forward guidance. Narratives become the substitute for enforcement. Markets initially accept this trade. Words are cheaper than consequence, but they still carry informational value temporarily. Over time, however, the gap between narrative and outcome widens. Markets track this divergence closely. When promises accumulate without resolution, belief thins, but still, reaction is delayed. Why? Because markets are adaptive, not moral. They attempt to survive within the system as long as survival appears possible. Only when adaptation fails do they exit. This is why the most dangerous period is the one where everyone agrees something is wrong, but no one agrees it is terminal. During this phase, volatility rises without trend. correlations increase, liquidity becomes selective, capital favors flexibility. These are not panic signals. They are preparation signals. They indicate that markets are positioning, not fleeing. Positioning can last years. Eventually, however, a threshold is crossed. Not when truth is revealed, but when belief is exhausted. At that point, reaction is no longer gradual, it is discontinuous. Liquidity vanishes. Spreads widen. Assumptions break simultaneously. Observers ask, what caused this? Markets already know the answer. They were waiting. This is the final reason markets react late. They do not move on information. They move on loss of confidence in correction. As long as participants believe the system can still correct itself, markets tolerate almost anything. When that belief disappears, reaction is immediate and irreversible. The collapse appears to come from nowhere, but it does not. It comes from a long period where warning signs were visible, analyzed and quietly discounted. The Epstein Files represent one such warning, not because of what they allege, but because of what they demonstrate. They show a system under credibility stress, choosing delay over correction. Markets see this pattern clearly. They simply wait until stress forces alignment between belief and reality. That is when reaction finally occurs. Not early, not late. Exactly when confidence can no longer be maintained. Systems do not fail because they are weak. They fail because they become fragile. Weak systems break early. Fragile systems survive longer, and then fail all at once. This distinction matters. Fragility is not visible in stability. It is visible in how much stress a system can still absorb. For most of modern economic history, global markets have operated with buffers, monetary flexibility, legal enforcement credibility, political legitimacy, and institutional correction mechanisms. These buffers allowed systems to survive mistakes. They absorbed shocks that would have destroyed earlier structures. But buffers are not infinite. They thin. And once thin enough, even small stresses become dangerous. This is where the global economy now stands. High debt levels reduce policy flexibility. Monetary intervention produces diminishing returns. Political fragmentation weakens coordination. Institutional credibility is already under strain. None of this causes collapse on its own. What it creates is systemic fragility. Fragility means the system still functions, but no longer tolerates surprise. In fragile systems, timing becomes critical. Sequence matters more than scale. Confidence matters more than fundamentals. This is why unresolved institutional failures become so dangerous at this stage. They reduce the system's remaining tolerance. The Epstein Files are not unique in this regard. They are representative. They show how modern institutions respond when correction threatens structure. Delay, complexity, process without resolution. In earlier periods, systems could absorb this behavior. Confidence reserves were larger. Legitimacy buffers were thicker. Today they are not, which means the same behavior produces greater damage. Markets do not measure fragility directly. They infer it. They watch how systems handle pressure. They note whether enforcement still works, whether consequences still follow actions, whether correction still occurs without negotiation. When these signals weaken, markets assume fragility has increased, and fragile systems change behavior. They become more sensitive to secondary shocks. They amplify feedback loops. They transmit stress faster. This is how localized problems become global events. Fragility explains why collapses cluster, why multiple failures appear unrelated but occur together, why energy stress, currency instability, political unrest, and market volatility often converge. It is not coincidence. It is loss of tolerance. In a resilient system, stress is absorbed. In a fragile one, stress is transferred. transferred across borders, across markets, across institutions. This is why global systems fail differently than national ones. Global systems rely on coordination and trust at scale. Once trust weakens, coordination fractures, and once coordination fractures, fragmentation accelerates. Capital begins to favor jurisdictions over systems, local enforcement over global norms, control over efficiency. This is a profound shift. It marks the transition from integrated systems to defensive ones, and defensive systems do not grow. They endure until they cannot. Another characteristic of fragility is non-linearity. In stable systems, cause and effect are proportional. In fragile systems, they are not. Small events can trigger large reactions. Minor failures can cascade. This is why analysts often misjudge collapse. They look for a large cause. There often isn't set one. There is only a system that can no longer tolerate disturbance. By the time collapse becomes visible, fragility has already done its work. Confidence has thinned. Liquidity has repositioned. Assumptions have narrowed. The system still exists, but it is hollowed. This is why confidence crises feel psychological but behave mechanically. Belief breaks first. Mechanics fail second. And belief is shaped by observation of institutional behavior. When markets see repeated instances where systems choose preservation over correction, they revise expectations. They assume fragility has increased. They prepare accordingly. Preparation does not look like panic. It looks like shorter time horizons, higher liquidity preference, reduced exposure to complexity, and increased demand for control. These behaviors slowly reshape the economy. Growth slows. Innovation narrows. Risk becomes concentrated. The system becomes even more fragile. This is the feedback loop. Institutional credibility weakens. Confidence erodes. Markets adapt defensively. Economic flexibility decline. Fragility increases. Next shock becomes more dangerous. This loop does not require scandal. It does not require revelation. It requires only unresolved strain. The Epstein Files matter because they represent strain that was not cleanly resolved. They demonstrate how modern systems handle credibility threats when the cost of correction appears high. Markets do not judge this morally. They judge it structurally. They ask, if correction is avoided here, will it be avoided elsewhere? If consequences are negotiable here, are they negotiable system-wide? These questions reduce tolerance. By 2026, tolerance is already low. Debt levels constrain response. Demographics reduce growth elasticity. Geopolitical fragmentation weakens coordination. Monetary credibility is thinner than it appears. In such an environment, fragility dominates. This is why the next major stress does not need to be large. It only needs to arrive at the wrong time. And that time is defined not by calendars but by confidence exhaustion. When confidence finally fails, systems do not gradually adjust. They reprice violently. Because fragility removes the middle ground, there is no smooth transition from belief to disbelief. There is only delay and then release. This is the defining characteristic of systemic fragility, and it is why markets that appear calm can fail suddenly. Not because nothing was wrong, but because everything was already stretched. Systemic collapse does not begin with panic. It begins when belief quietly expires. By the time markets visibly react, the decision has already been made, not consciously but collectively. Confidence does not disappear all at once. It thins. It becomes conditional, then selective, then transactional. Eventually, it stops functioning as a foundation and becomes a liability. This is the moment systems cross from instability into inevitability. In earlier chapters, we examined how markets depend on confidence, how institutional behavior signals reliability, how legitimacy underpins stability, how silence reallocates risk, how markets react late, and how fragility accumulates. Chapter 7 is where all of those forces converge. Because confidence does not break in isolation. It breaks when stress meets exhaustion. Every system has a tolerance for contradiction. Contradiction between narrative and reality, between enforcement and outcome, between stated values and observed behavior. As long as that contradiction remains manageable, confidence survives, but contradiction accumulates. Each unresolved institutional failure adds weight. Each delayed correction narrows margin. Each instance of silence stores pressure. Eventually, confidence is no longer supported by belief, only by habit. And habits collapse under stress. This is why the final phase of systemic failure feels abrupt. Not because collapse is sudden, but because belief was already gone. Markets functioned on inertia. When inertia meets stress, reaction accelerates. This is the moment when observers say, everything changed overnight. It didn't stress. Everything simply aligned. When confidence breaks, markets stop assuming continuity. They stop extrapolating the past into the future. They stop trusting intervention. They stop believing that stabilization will arrive in time. This shift is subtle at first, but once it spreads, it becomes irreversible. Liquidity behaves differently, not less, differently. It becomes conditional on control rather than opportunity. Capital stops asking, where can I grow? It starts asking, where can I still exit? This is a critical transition. Growth systems rely on commitment. Survival systems rely on mobility. Once confidence breaks, mobility dominates. This is why collapses are accompanied by capital flight, fragmentation, hoarding of optionality, retreat from complexity, not because participants are irrational, but because the system no longer offers protection. Confidence is what allows complexity to function. Without it, complexity becomes risk. This is why global systems fail differently than local ones. Global systems require trust across distance, culture, law, and enforcement. Once confidence weakens, global coordination deteriorates first. Supply chains shorten. Capital localizes. Standards fragment. The system does not collapse instantly. It retracts. Retraction feels orderly until it reaches a boundary. Then it snaps. This is the final role of unresolved institutional failure. It does not cause collapse directly. It reduces the credibility reserve that would otherwise absorb stress. The Epstein Files matter here, not as a cause, but as evidence of a broader pattern. They demonstrate how modern systems respond when correction threatens structure. They show that preservation often takes priority over resolution. Markets internalize this. They adjust expectations. They assume that future crises will be handled similarly. This assumption is devastating in late-stage systems, because late-stage systems do not have room for delay. They require decisive correction to restore confidence. When correction is postponed, belief does not wait. It leaves. Once belief leaves, systems lose the ability to coordinate behavior voluntarily. Compliance replaces cooperation, and compliance is fragile. Markets do not trust compliance. They price risk as if enforcement may fail. At this stage, even positive data fails to restore confidence. Growth numbers are discounted. Policy announcements are questioned. Stability is treated as temporary. This is why late-stage recoveries feel weak. They lack belief. Confidence cannot be restored with reassurance. It can only be restored with consequence. And consequence becomes harder to deliver the longer it is delayed. This is the final trap. Systems that delay correction to preserve stability eventually lose the ability to correct at all. They wait too long. When stress finally forces action, the cost is too high. Legitimacy cannot be repaired quickly. Trust cannot be rebuilt on demand. Markets cannot be convinced to return once they have adapted to exit. This is why collapses cluster. Not because multiple things go wrong at once, but because confidence failure synchronizes reactions. Once belief breaks, everything reprices simultaneously: energy, currencies, debt, risk. Observers search for a trigger. They point to an event. But the event is merely the moment confidence exhaustion becomes visible. The real collapse occurred earlier, quietly. This is the final lesson of economic history. Systems rarely fail because they lack resources. They fail because they lose legitimacy. They fail because institutions protect structure over credibility. They fail because silence replaces correction. They fail because confidence erodes faster than anyone admits. By the time collapse is acknowledged, markets are already gone. Not physically, psychologically, and markets are psychological systems. They operate on belief, expectation, and shared assumptions. When those assumptions fail, no amount of capital can force stability. This is why endings feel unfair. Because participants did not cause the collapse, they merely responded to it. And response is rational when confidence is exhausted. The Epstein Files, like many unresolved institutional failures before them, are not the story. They are a signal that correction carries a cost the system is unwilling to pay. Markets notice that. History records it. And confidence adjusts accordingly. When confidence finally breaks, collapse is no longer a possibility. It is a process already underway. What remains is not prevention, only navigation. History rarely ends with noise. It ends with silence. Not the silence of ignorance, but the silence that comes after belief has already left. By the time collapse becomes visible, markets are no longer debating what might happen. They are acting on what they have already concluded. This is why economic endings feel sudden. Not because they arrive without warning, but because the warnings were structural, not dramatic. They appeared in behavior, in delay, in silence. In the quiet protection of systems over credibility, the Epstein Files were never about scandal. They were about process. They showed how modern institutions behave when correction carries a cost. They revealed what happens when accountability threatens structure. And they demonstrated how confidence erodes without headlines. Markets understand this language fluently. They do not wait for moral resolution. They do not wait for explanations. They do not wait for permission. They wait only until belief is no longer sustainable. And when belief fails, reaction is no longer gradual. It is decisive. This is the pattern history repeats across empires, currencies, and systems. Not collapse first, but confidence last. Understanding this is not about fear, it is about orientation. Because when systems begin to fail, the most dangerous position is confusion, and the most valuable asset is clarity. History does not punish those who see clearly. It punishes those who assume stability will return simply because it always has. Every era believes it is different. Every system believes it is resilient. Every collapse proves otherwise. The lesson is not that systems fail. The lesson is how they fail, quietly, structurally, and long before anyone is ready to admit it. If you understand that, you are no longer reacting to events. You are reading the system itself. And that is the difference between being surprised by history and recognizing when it has already turned the page.